Welcome to Talk Tickers. Today we're digging into PACCAR's latest fourth quarter earnings. Now on the surface, the numbers looked fantastic, but the stock? Well, it told a completely different story. So what's really going on here? Let's break it down. Okay, so let's get right into the head scratcher. PACCAR came out and reported revenues that just absolutely crushed what analysts were expecting. We're talking by over $780 million. That is a massive beat. But then you look over at the stock, and it actually finished the day down over 1%. You know, a beat like that should send a stock soaring. This is a major disconnect, and it tells you that the headlines are missing the real story. And that's the big question we're going to answer today. The market is always looking ahead, and it clearly spotted something under the surface that gave it pause. So let's go find out exactly what that was. First things first, let's look at those top-line numbers that caused all the initial confusion. All right, so their earnings per share, the EPS, came in at $1.06. Now, depending on which analyst you're looking at, that was either a tiny beat or a tiny miss. Really, it was basically in line, a wash. The real story, the showstopper, was the revenue, $6.82 billion. That wasn't just a beat, it was a complete blowout. I mean, just look at the scale of this. PACCAR didn't just squeak by the consensus number, they blew right past it. This is exactly the kind of number that makes headlines and, you'd think, makes for some very happy investors. But obviously not this time. So, what's the first clue in this puzzle? And here it is. This is a big one. Even though they crushed this quarter's estimate, that revenue number was still down almost 14% from the exact same quarter last year. This is a flashing sign that the heavy-duty truck market is slowing down. It's in a cyclical downturn. The freight market has been soft, and that just means fewer new trucks are getting sold compared to last year's peak. Okay, so knowing that the truck cycle is working against them, management spent most of the earnings call telling a very specific story. It's a story of structural resilience. They're making the case that PACCAR is a fundamentally stronger company now, one that can perform well even when the market is weak. And here's their argument. While new truck sales are always going to go up and down with the economy, the other parts of the business are growing and providing some real stability. PACCAR Parts, which is their aftermarket business, actually hit record revenue. And these segments, the parts and the financial services, they're higher margin, they're way less volatile, and they're becoming a bigger and bigger piece of the overall pie. You don't have to take my word for it. This quote from the CEO, Preston Feight, nails their whole point. The strategy is pretty clear. They want to build a business that can perform well through all phases of the economic cycle, not just when things are booming. But as we know, the market doesn't just listen to the story, it looks for proof in the forecast. Which brings us to guidance. And honestly, this is almost always the most important part of any earnings release. This is where management puts their money where their mouth is and gives their official forecast for the future. And it all came down to this number right here. Management guided for first quarter gross margins to land somewhere between 12.5% and 13%. Now, that is an improvement from Q4, which is good, but it's a pretty cautious improvement. And this is what the market really latched onto. It's a signal that cost pressures are sticking around and capping their profitability, even with some good news on steel tariffs. During the Q&A with analysts, they got into the nitty-gritty. They explained that Q4 margins got hit by some one-time costs from shifting production around, plus they had to pay more in overtime. They do expect those headwinds to fade in the first quarter, which is good. But for investors listening in, that cautious guidance was the real takeaway, and it completely overshadowed that huge revenue beat. So let's put all these pieces together. You've got the big revenue beat, the cyclical pressure from a soft market, and that cautious margin guidance. What's our take on the stock from here? All right, here's our official take. We're rating PACCAR as a market perform. The thesis is pretty straightforward. We believe management's story about building a more resilient business. It holds water, especially when you see the strength in their parts division. But you just can't fight the cycle. The margin pressure in the short term and the still soft freight market will probably keep a lid on the stock. So for the next earnings call, all eyes are going to be on that margin number. Did their guidance turn out to be too conservative, and whether truck orders are picking up steam? Now, there's one more thing to keep on your radar, a potential catalyst down the road. Management confirmed that these new EPA 2027 emissions rules could add about $10,000 to the price of a brand new truck. This creates a huge incentive for trucking fleets to buy their new trucks in late 2026, before that price hike hits. It's a phenomenon called a pre-buy, and it could create a massive surge in demand as we get closer to that deadline. It's definitely something investors are watching very, very closely. And all of this really brings us to the final big picture question. There's no doubt PACCAR is becoming a better, stronger, more resilient company. But the truck industry is famous for being incredibly cyclical. So the ultimate question for any long-term investor is this: are those internal improvements enough to overcome the powerful gravity of the broader economic cycle? This is not financial advice.